Okay, so welcome everyone, and nice to see you all here and to start trading with OneRoyal broker. So we'll start with our webinar today, which is leverage. We will show you how leverage work and how to calculate or how to, let's say, use the leverage into your advantage. First, a quick disclaimer, the information provided in this webinar is for educational purposes. Please do not take them as financial advice. Do your own research before start trading. So these are the points that we will cover today. What is leverage? Understanding leverage ratios, leverage in Forex and CFDs, the deposit or the margin requirement, what is margin call, and for sure we will give you tips to use leverage correctly, and finally we will go to MT4 to show you a live example. What is leverage? Leverage is an investment strategy of using borrowed money, specifically the use of various financial instruments or borrowed capital to increase the potential return of an investment. This definition is provided by Investopedia. I can give you a very simple example of leverage. Let's say you would like to buy a house, but you don't have the full amount. So usually what you do is you will put a small amount, which is the deposit, and based on that, the bank gives you a loan to be able to buy the whole, let's say, the whole amount, or to use the borrowed money to buy the house and to be able to get the whole amount. So I will repeat, to be able to buy a house, usually you use a small deposit and then you get a borrowed money from the bank to be able to buy this house. This process is leverage. Okay, this is in a simple way. We will use this process in trading. So what you will do is you will use small amount to be able to trade big. Leverage ratio. Leverage is expressed as the following, X to 1. So when you open any broker website, you will see that leverage, let's say, equal 100 to 1. What is 100 to 1? That means for each dollar you deposit, you will get $100 as borrowed money from the leverage. Okay, so the 1 is the amount of your money you put as you deposit, and X is the amount you actually trade with after the leverage. So if you deposit $10 on 100 to 1, you will be able to trade $1,000. So your purchasing power is bigger. You will be able to generate more profits as well. I can give you an example here with Bob and Jim. Okay, so here those two guys are willing to buy a similar house with similar price, which is 100,000. Jim is willing to pay the whole amount as cash. However, Bob, he doesn't have the full amount. What he will do is he will deposit a small amount, which is 50K, or this is the down payment. And he will get as a loan 450,000. So Jim, he paid the full amount as cash. However, Bob, he used just a down payment and the rest he get as a loan from the bank, let's say. The debt has a cost or interest fees, which is 20,500. And let's say both of them, they decided to sell this house at the same year and at the same price, which is 550,000. Let's see the effect of leverage here. So the money made with Bob is 27,500. How this is calculated? This is 550,000 minus the debt or the initial amount that he should return to the bank, minus the interest fees, and minus the initial amount he deposited. So he will end up making 27,500. However, Bob, he made 50,000 since he didn't use any debt. There is no interest fees. So the initial amount he deposited is 500,000. So he made around 50,000 US dollar. If we so in dollar amounts, Jim did more than Bob. Okay, so in dollar amount, Jim did more than Bob. 50K is more than 27,500. However, if we calculate the return on investment, which is more important than the dollar amount, we can see that Bob did around 55%, which is bigger than 10%. So how did I came up with 55%? It is 27,000. Let me try to clean everything here. So it is 27,500. The 55, it is 27,500 over 50,000, which is around 50%, but with the 7,500 is 55%. Okay, so the 55% came this divided by this amount. Okay, so this is the 55%, the return on investment. The 10% is 50K divided by 500. So in terms of return on investment, Bob did more. Okay, so this is the use or the power of leverage. By using a small amount, you did a good amount of profit. In terms of return on investment, it's better than using the full or the cash amount as Jim did. Next, the leverage in Forex and CFDs. As obvious, the larger the leverage ratio that you use, the larger the position you can take when Forex and CFD trading. So when you higher the leverage ratio, then you will be able to trade with bigger amounts. Okay, this is the concept here in CFDs and Forex and any other financial asset. So the higher the leverage, the bigger the amount that you will be able to trade. If we go to this table here, we can see that we have leverage, capital invested, purchasing power. The profit is, let's say, we fixed it to 1% on each trade, and we have the return on investment. So the capital investment is always $1,000. If we have a leverage of 2 to 1, this capital invested will be doubled. So 2 to 1, that means 2 times the capital invested. So we have a purchase power of $2,000. And if we make each time 1% profit on this purchase power, this is $20. And $20 divided by this amount here, the capital invested, is 2%. Okay, this is the return on investment. So you're making 2% on your capital invested if you use a leverage of 2 to 1. However, if we scale up the leverage to 100 to 1, that means the capital invested now is 100,000. So in CFDs, let's say if you have 1,000, you will be able to trade with an amount of 100,000, which is 100 times the $1,000. And if you make, as we see here, 1% on each trade, that means 100,000 times 0.01 or times 1%, which is $1,000. $1,000 divided by the capital invested to get the return on investment, which is 100%. So you can see that the 2% now became 100% if we higher the leverage. Okay, so what we did is we scale up the leverage. So this is 50 times more. 100 divided by 2 is 50 times more. We increase the leverage, and this will impact here the profits by 50 times. Okay, so 2% times 50 equal to 100%. And similarly, if we higher it more and more and more, then the profits will be higher and higher. Okay, this is the power of leverage. Margin requirement. Margin requirement as a definition, as you remember when we gave you the example of the house, Bob used a deposit or kind of down payment. This down payment is the margin requirement. So to be able to get a loan from the bank, in the example of Bob and Jim, Bob should deposit a small amount of money. Okay, and similarly in trading, to be able to trade big, or in another word, using leverage, you need to deposit a small amount of money, which is the margin requirement here. Okay, so we have two common keywords, margin and leverage. Margin is like a deposit or guarantee taken by your broker, and they use this margin and they will amplify it to be able to trade big. So this is the leverage. They use the margin, they will amplify it. This is the leverage, and then you will be able to trade big. So this is the difference between margin and leverage. So if we go to this table here, what we have? We have in the first section, leverage, required margin percentage, nano, micro, mini, and standard lot. So here we're gonna see, let's say, the effect of leverage and how much margin requirement you need for each lot. If we're talking about nano lot, okay, which is $100, usually I should tell you something here, that usually the standard lot on MT4 is 100,000. Okay, so if you put 1 as volume in MT4, you are trading 100,000 units. However, there are other accounts which are nano, micro, mini, and maybe smaller, but this is the most common ones, nano, micro, mini, and the standard. And this is, you should ask your broker if they have it. Okay, so here we should see the margin requirement based on each type of lot. So if you have a leverage of 200 to 1 and the required margin is 0.5, so this means to be able to trade a nano lot, which is $100, your broker asks you to deposit 0.5% of this 100, which is $0.50. Okay? In case you are trading, let's say, a micro lot, which is $1,000 here, should be, this is $1,000. That is a mistake, sorry for that. So 0.5% on 1,000, this is $5. For a $10,000 USD, so to be able to trade a $10,000 worth of a pair, let's say you need just 0.5% of this, which is $50. So can you imagine, by depositing $50, you will be able to trade $10,000. So this is the power of leverage, and the required margin or the guarantee or the deposit needed is just $50. Okay, so if you would like to know how this affects the process, so 50 times 200, the leverage, equal to 10K or $10,000. So this is the margin, the deposit needed from your broker. This is the leverage. So they amplify your margin, your deposit, to be able to trade $10,000. This is the whole process, guys, okay? And you can see the other examples here. We will not go through them, but let's say we take just one. Let's say 10 to 1 on a 10% required margin. So here your broker is asking you to deposit 10% on any position you open. Let's say in a nano lot, you should deposit 10% of 100 USD. So you should deposit $10. By depositing $10, you will be able to trade $100. Okay, 10 times 10 to 1, which is the leverage, you will get this number here, $100. An example here on margin and leverage. So let's say you have an account of $5,000. Let me make this clearer a little bit since it is a lot of writings here. Okay, so let's say you would like to trade a standard lot. The standard lot is 100,000 US dollar. Okay, but you have just $5,000. We need to trade one lot, which is 100K. Okay, and we just have $5,000. If we take the first example, let's say you have a leverage, or your broker provided you with a leverage of 50 to 1 to be able to trade 100,000, the margin required is 2,236. You should deposit 2,236 to be able to trade 100K or 100,000. How did we came up with this number? What we did is divided 100,000, which is the lot that you would like to trade, divided by the leverage, which is 50. Then you will get here 2,000 or 2K, I will call it, but this is $2,000. Since we are trading Euro USD, this is the difference between the conversion rate. So it's around 2,266. Here we're trading, 100,000 euros. So the conversion rate will have a 236 difference, okay? But 100,000 divided by 50, it's 2,000 euro, and 2,000 euro is around $2,236. Okay, so this is here the example of 50 to 1. However, if we take this example here, we will remove 50 and we will use 1,000. So to be able to trade 100,000 with a leverage of 1,000, so you have here a leverage of 1,000 to 1. That means for each dollar you deposit will get 1,000. You need, so here we're trading 100,000 euro, the lot divided by 1,000. This is 100 euro. Okay, you should deposit just 100 euro to be able to trade 100,000 euro using this leverage here. 100 euro is around $112. Okay, if we are considering that the Euro USD is 1.12. Okay, so now what's this represent as a percentage of your account? So to get this number here, so how much the margin requirement represent as a percentage of your account, I will show you the calculation. Let me make this clearer. Okay. So how did we come up with those percentages here? 44.72%. How did I came up with this number? So the required margin, or the margin requirement, is the same. Represent here 2,236 divided by this number, 1 divided by 2, you will get how much this margin requirement represent as percentage of your account, which is 44.72. So whenever you open a trading idea based on these inputs here, which is one lot, and you have this account, the margin percentage will be 44.72%. They take as a guarantee 44.72% if we're using this leverage here. However, if we're using 1,000 to 1 as leverage, they will take just 2.24% of your account as a required margin or margin requirement. Okay, so 112 divided by 5,000, this divided by 2, you will get 2.24%. Okay, so you just need to deposit 2.24%, a partial of your $5,000 as a guarantee to be able to trade one lot, which is $100,000. This is the difference between margin requirement and leverage. Another thing that I would like to mention here, so if you have just a small amount of your account freezed, let's say 2%, you still have around 98% to trade with other assets. This is the advantage here also of leverage. We will go to this slide, which is margin calls. Margin call is sent by a broker to a trader to notify them that they do not have enough funds in their account to cover the margin for a trade. Okay, so this, back in the days, they usually send you an email or call you to tell you that you don't have enough money in your account to cover the margin requirement. Okay, but these days, or in CFDs and Forex, what they do is automatically they will close or liquidate your positions once you don't have enough funds to cover the margin. So we said the margin is like a deposit. It's like the deposit to be able to trade big, but however, if there is no enough equity in your account to cover this margin, let's say your trade went against your direction or it went against you, then you will start to lose money. If there is no enough equity in your account to cover this margin, then you will be stopped out and then your position will be liquidated automatically by the broker. We will give you an example on MT4 as well to explain you those terms: margin, leverage, and many other things. Tips to use leverage correctly. So to be able to benefit from leverage, because leverage is a double-edged sword, so you can make big amount of money, but also you can lose the same amount of money if you don't know how to use leverage correctly. So we will give you some tips here. First, as A, calculate margin requirement in dollar, calculate remaining account equity, calculate your stop loss not in pips, in dollars, and use the stop loss or in dollars should not be higher than the remaining equity. Okay, so I will explain about this. And finally, we recommend you to not risk more than 5% on each trade. So usually when you will start to trade, you will not do all of these by yourself or on a paper. You will not calculate this. What you will do is you will use a position size calculator, which is a calculator. You can find it all over the internet. Just type position size calculator. Just you will input how much you want to risk. Let's say 1% of your account, 2%, or maybe up to 5%. You will put the pair that you would like to trade, let's say Euro USD, and how many pips you are willing to risk. Okay, this is the stop loss. So you will input the stop loss. You can put it in dollars or pips. How much you are willing to risk in terms of percentage of or dollars as well you can use, and you will put the pair that you would like to trade, and then the calculator automatically will give you the position size. Okay, the position size is the volume on MT4. So to be able to know how much you need to open as a position on your MetaTrader 4, 1 lot, 2 lots, 3 lot, it depends. To know these numbers, how much you should use, you will use this position size calculator to be able to come up with the right position size, and this way you will be able to use the leverage correctly. Here we will give you an example of two traders that are willing to use two different leverage, okay, with different lots, number of lots. Okay, so here we'll show you the leverage effect on potential loss. So we will show you the loss if you use the leverage in a bad way. So we will show you the difference, and we'll show you how the leverage will affect your losses. Let's say both of them, they have in the beginning $10,000. This is their balance. But trader A is willing to buy 25 mini lots. This is a mini lot, not a standard lot. Okay, so they are willing, trader A is willing to buy 25 mini lot. However, trader B is willing to buy 5 mini lots. Okay, so with $10,000 to be able to trade this big amount, you need a leverage of 25 to 1, which is this divided by this. So the leverage gives you the opportunity to trade big by using a small account, which is 10,000. You're trading 250,000 US dollars. So this is our leverage for trader A. The trader B has a lower leverage because he didn't open a big position similar to trader A. So here, to be able to trade 50K or 50,000 US dollar, he used a leverage of 5 to 1. This divided, so in the opposite, this divided by this. Okay, 50,000 divided by 10,000, this is 5 or 5 times. In case the trading idea didn't go well, it went in the opposite direction of both of those traders, then trader A, he will lose $2,500 if the asset went in the opposite direction of the trade by 100 pips, and the trader B, he will lose, or she will lose $500 if the trading idea went against her by 100 pips. So if you need to know the calculation of the 500 and 2,500, I can do it quickly. How did I came up with those numbers? So for a mini lot, each pip increase or decrease, this is a $1 loss, or let's say variation. So here we have a move in the opposite direction of our trading idea. So for each pip that goes against us, this is a loss of $1 because we're using a mini lot. And a standard lot, this is $10. But for here is $1. So $1 times 100 pips, so we have a loss of 100 pips. So minus $100 and times the leverage, which is 25, then we will get 2,500 as a loss. However, here we're showing you how the leverage will affect your losses, not just your profits, so you should be aware of how to use the leverage correctly. The guy here, trader B, he didn't use a leverage of 25, he used just 5. So his losses or her losses is just 500 instead of 2,500. And when it comes to how much he lost of his account, 2,500 divided by 10,000, this is 25%. However, trader B, he lost just 5% of his account, which is 500 divided by 10,000, it is 5%. So trader A lost 25% of his account, which is 5 times the trader B, or this is a huge loss for the trader A. Okay, so this is an example of how leverage can affect your losses as well. So please try to use leverage correctly by using the position size calculator. Now we will go to NT4 to talk a little bit about leverage. So here we have GBP CAD. Okay, GBP CAD, if we need to open a trade, I will give you an example of margin required and leverage in this MetaTrader 4 platform, so you understand what we're doing. So here we're using one volume. As I said, one volume, that means $100,000, okay, or 100,000 GBP CAD. Okay, let me give you an example, more simplified one on the Euro USD. So Euro USD, okay, let me use the Euro USD, it's easier because GBP CAD, it is a cross pair. Okay, so I will not use the chart, so no need. So I will buy 100,000 euros or one volume, using one volume, which is 100,000 euros, and we will see the margin and the leverage effect on the bottom here. Okay, so I opened a 100,000 euro position on Euro USD. As you can see here down below, the broker took as a margin on 100,000 euro. The margin here taken is $1,059. We have an account in dollar. So they, let's say, freeze 1,059, which is 59, which is the deposit or the down payment as a guarantee, and they give you the purchasing power to be able to trade 100,000 euros. Okay, so you understand now how the leverage works. So they give you around 100 to 1, or for each dollar you deposit, they give you $100 to be able to trade big. Okay, so if you look here, we have the margin. This is the margin requirement in the slides. The leverage is 100 to 1, so 100 times 1,059, it's around 100,000 euro. That is the conversion rate. This is a little bit different. You know, that is like $59, okay? So this is, since we have a USD account, and we are left as a free margin 8,430. So how did we come up with this number? It is the equity minus the margin taken by your broker. You still have $8,432 to be able to trade with or to use as margin for other trading ideas. Okay, so this is the margin and leverage on MT4. Let's get back to our presentation. So this is it for today's webinar. Hope you enjoyed it. Please let me know if you have any question about this topic before ending our session. So I will wait for your questions in the chat in case anyone have one. Any doubts or question? Okay. It seems there is no question for today. Thanks for attending this webinar and see you on next Tuesday for the market update. Have a lovely day.